Welcome here. My name is Gerbert van Grodeest. I'm heading the risk advisory group of Zanders. So probably from my perspective, even a bit unwise to say it's not about risk. So probably we can compromise and say it's about liquidity risk then. Why does liquidity matter? I think Lawrence Steit have already mentioned a few topics, and we all know the volatile interest rate markets and other markets, the geopolitical situation, but for example also the scrutiny from the regulator on intraday liquidity, client behavior, cash is gone with a click, and also coming up the instant payments during the weekends, which is quite, I would say, liquidity-wise, quite a challenge, because if banks have to pay the cash in case of salaries during the weekend, there is no infrastructure, there are no markets, so there is nothing. So some French banks, for example, already say liquidity in the weekend for me is not an issue. Let's face the reputational risk. If we don't have liquidity, we don't have it. There is no one backing up, so it's what it is. Which is quite a statement compared to what we all used to in the financial sector. So we have luckily a great panel to discuss liquidity risk. It's not me. May I introduce you, Annelies Natchev?
Yes, please.
15 years of experience in cash management and payments and digital transformation on treasury, on everything that has to do with liquidity, I'd say. Working for Moss as a sales manager, and she will be our moderator this afternoon. Then Niklas Fellman, he's a colleague of Annelies and the commercial officer of Moss. I think even more years of experience, 20 years of experience in the digital transformation of the company, and you may be not surprised that he's advocating about real-time platforms in the financial sector, and frankly speaking, he's right about it. You said to me, I don't like bios, but one thing that wonders me after our intro is the name of your dog. Because you can point to that. He said, all the bios, I don't like it, it's too much information, and you were pointing about the name of your dog, so probably it's an interesting one. And then, last but not least, a colleague, Erik Vijlbrief, one of our partners in our practice lead in Europe on asset liability management and bank treasury. So I think we have quite a marvelous panel to share with us everything they know about liquidity risk, intraday liquidity risk, etc., and share with us the banking experience. So, floor is yours, Melita.
Thank you. Actually, I'm modern, so I have the wearables. So before we start, have you all downloaded the app so you can do the polls that we're gonna do? Because it's a really good way to interact with this session. So before we start, you saw our short video about Morse, but for those of you who have not heard of us, so we're a Finnish company, and we work with financial institutions around Europe with treasury and ALM. And thank you all for making the long way up the stairs here to see us for this session. So let's kick it off. Before we do, just to see who we have here with us today. So who are with us today? So we're going to talk about financial institutions, but of course we have some stuff for the rest of you as well, so you can vote really quickly. So we see. Do you have your? No. Okay. I'll let you do the voting. So before we start, we talked a lot about. Okay. Nice. So we talked a lot about dancing to the music, and that music is liquidity at the moment. So today what we will be speaking of is liquidity and liquidity risk management. So we can argue, are they the one and the same thing? We're going to talk about that today. And lately, regulatories and best practices all the times are stressing that fragmented liquidity systems for intraday, regulatory work, and so on, they create inefficiencies and vulnerabilities. So integration is maybe not longer optional. So my first question is to you, Erik. From your expertise, from your consulting expertise, what are the most common operational challenges that banks face due to fragmented liquidity systems today?
Yeah, that's a good question, Annalisa. I think it's good to indeed make first a distinction between the liquidity risk management, indeed, which is basically everything between 1 day and everything in a year's time, but also, of course, intraday liquidity, where it's more about near real time and managing that on a really through the day basis. I think that most banks have moved indeed from a situation where they had insight in their liquidity risks on a monthly basis to something that is now at least at the start of the day being able to understand the cash ladder, the payments that need to go out during the day, that they know that upfront, can do some stress testing on that. But really moving towards an intraday situation, of course, is the next step, and really requires you also to integrate your systems. And I think, especially from a regulatory perspective, we see Gerrit already mentioned, of course, the instant payment regulation, which will be quite impactful in that respect. But in addition, also, of course, we've seen the ECB publish the sound practices on the intraday liquidity risk management, where also the expectation of the regulator is quite clearly stated, also requiring you to be able to really understand customer behavior in that sense, also have intraday warnings to be able to do that. And being able to do that really requires you to integrate the system landscape.
Okay. In this, let's take a short poll again, if we can have it on the screen, please. So when we're talking about intraday liquidity flows in real time across currencies, units, and bank accounts, so if we can have your votes, if your organization is able to actually monitor that. And while you answer, my next question for Niklas, so we can wait with the results a bit. We at Morse and you have been working a lot with banks who are doing treasury transformation or undergoing treasury transformation, maybe we should say. So what have been the most effective strategies that you've seen to actually break down the liquidity system silos and achieve integration?
Yeah, thank you. That's. I think we need to look at that a little bit from different or through different lenses. So on one hand, if we have the medium and small-sized banks, I think it's more realistic for them to have broader systems, and that way, like, have broader systems that cover more aspects of liquidity risk and intraday liquidity indeed. And that's also, let's say, fully realistic to do that, to have, for example, one single system where you do both your intraday liquidity monitoring as well as calculate things like your LCR or NSFR, survival horizon, and other metrics that you probably do on a timely basis. So I think that is probably for the medium, smaller sized banks, that's the best way to do it, to have broader systems. And one of the key things that we see that to break down the silos is really the benefits of it is that if you have broader systems, you avoid this eternal reconciliation that you then have if you use multiple systems that partly overlap the liquidity and liquidity risk landscape. And that is a little bit sometimes maybe like chasing your own tail, and that's something to probably avoid. If we then look at the larger institutions, so that's of course not then really realistic to say that you have just one system or a few systems. You're obviously then dependent on a number of systems that all have their own distinct roles and responsibilities. So then it's more like this integration challenge. So it's more like a data architecture challenge, probably, being able to provide the different data points so that you have a coherent data architecture, and that's probably how we see it a little bit.
Yeah, so we just see we don't just see them, we saw them a while ago. So the results are in. are we surprised? I think we were expecting a bit like this, the results. Yeah?
Well, I guess from my side, I'm not so surprised because we see roughly 50, just under 50% no real-time visibility is possible. And at the end of the day, it's so easy to say real-time. And of course, I sit here as a vendor and I advocate real-time and say that that's what everyone should strive to. But the reality is that we'll come to that a little bit later. But many a time to achieve, let's say, real-time, and even real-time might be quite a stretch. So let's talk about near-time, which is a term I think is more realistic to use when we talk about liquidity and intraday liquidity. So even achieving something like near-time, that of course is not dependent just on system, but it's really the source data needs to be accessible. And we'll talk about that a little bit later, because I think probably if we had another poll question asking financial institutions here, how many of you see it as a challenge to gather all the data points and the source data in order to be able to track in near time, real time? Probably you would all raise your hand and say that is a challenge. But yeah, let's come back to that.
So one golden source of data. Yeah, that's what we're looking for. But if we move on here to going from reactive to proactive liquidity management. So the ECB expects banks now, like you mentioned, to monitor intraday liquidity across entities and currencies, and they say in real time. But we are still relying on siloed data. What about dashboards and early warning and proactive risk management? From your point of view, when you're evaluating a bank, from readiness, government's point of view, what are the key features that you look for in the bank's current liquidity monitoring capabilities?
Yeah, I think that indeed the first step to, like you mentioned, near real time is well, quite an important one, but also a challenging one to do. But if you do have, of course, insight on a day-to-day basis, or also throughout the day, and then also an important step to make is to really move towards a risk appetite on intraday liquidity, being able to really measure and also estimate the maximum appetite for the cash level, for example, throughout the day, and being also able to respond to that, having the measures in place to also already thought about what you will do if those limits will be reached. I think also if we look at, for example, the front runners in that, also publication of the ECB, and they talk really about throttling payments, really prioritizing payments between the ones that really have a fixed timing and also a date, to the ones that are maybe a bit more discretionary and need to be can be maybe shifted around. I think that is really about steering the liquidity position throughout the day and making that move is I would say quite relevant.
Okay, so risk appetite. Let's do a short poll around that topic. So does your organization have a risk appetite defined for intraday liquidity risk? And let's wait a bit with the answers. I'm going to ask Niklas here first. So we actually have been talking a bit about what the key enablers are for real-time or near-time liquidity monitoring in practice. What pitfalls do you think that banks should avoid when trying to move from daily to intraday insight?
Yeah, thank you. I think there's a couple of pitfalls, but it really going back a little bit to my first comment on the data. So the source data, it starts and ends there. If you have your data architecture in place, your data availability in somewhat uniform manner and somewhat timely manner, then I think the keys to success are with you. If it's the opposite, it's going to be an uphill battle no matter what what you do, and it doesn't make sense even if you would have a great system like Morse on top. If you don't have the source data, it doesn't really help. So I think it starts and ends with the data, and I think some of the pitfalls then also like that we've seen is that if you strive to being able to have access to everything in near time, real time, then that's probably going to be a hard slog. So what we tend to see is that if you're an organization who is not willing to do compromises and only focus on the material risks, then it might be a tough one. So maybe again, and it ties a little bit back to what Erik said about when the risk appetite has been defined and you have your risk appetite framework. So tying that back to what are really the material risks and what are the material data sources that you need to make the whole engine run. And so yeah, that's maybe a pitfall. If you strive to cover it everything, then you might lose a lot of time and energy rather than focusing on the really material stuff.
Okay, so let's look at the poll results. 75% says that they do not yet have it. How would you comment on this?
Yeah, well, still some room for development, I would say, indeed.
Okay.
And I think, it's quite a first step to first of all, being able, of course, to understand the data, and then also, setting, at least the management actions. What are you going to do if those early warning signals, for example, are triggered?
So this has to do also with the people, like we talked about this morning. It's not just to have a set of rules and regulations in place. It's about working with the people on the team to actually work through what it means to have this. Yeah. Okay. So to the next topic, basically something we work a lot with, stress testing. But stress testing that reflects reality. And this morning, I think a really good point was that there's a lot of guidelines. EBA is pushing out everything yet. Not this poll question yet. Thank you. Let's take it soon. Anyway, so there's a lot of compliance that we have to do and fulfill, right? But we should also make sure that what we're doing is operationally sane and useful for the organization, and it must simulate plausible customer behaviors and possible shocks. Like we heard, there is a new market crash coming. We just don't know when. So, Erik, how would you say that banks could add behavioral elements into their stress testing frameworks, and what are the benefits of doing so?
Yeah, that's really an interesting question, and that was also tricking me a bit when I was reading through the ECB observations. Is that some front-runner banks actually do use customer behavior to analyze payment behavior and being able also to respond to that. And I think that the first step, of course, is making sure that your data is ready and can be analyzed. And I think that many of the liquidity systems that have been used, or the liquidity reporting that is in place, still makes use a lot of the contractual details of the payments to actually be able to forecast the liquidity.
Assuming everybody acts like in the contract.
Indeed, and whereas of course we all know that is not the case, and I think that especially if we make the bridge to the interest rate risk topic within ALM, of course we have been studying customer behavior for years from a liquidity perspective, not so much yet, but here also of course data sources are quite more expansive in that sense, also for being able to analyze it. So compute is an important point there as well. Making that use of, and here's the buzzword, of course, AI, making sure that you can analyze the data source and the customer behavior will help you, of course, being able to better forecast also your liquidity flows.
Yeah. let's take the poll question now. I think now is a good slot. So stress testing. So the question is if your organization already has something in place, and focusing on the daily basis here. We're going to let you answer, and then building on this, how has banks, what you have seen, been able to successfully implement scenario planning in day-to-day treasury operations?
Yeah, thank you. I think, on this one, I believe the user centricity of the tool is key. So what we put a lot of effort on is really try to put a tool in front of the bank and its risk people and treasury users, which is really let's say user-centric and as intuitive as possible. And the reason for this one is clearly that if you have something where there's a very high threshold to try different things, try different stresses, try different scenarios, and so on and so forth, then it becomes pretty tough. So what we're putting a lot of effort on is really that without, let's say, any coding, for example, or any other like technical skills, you should be able to define your own stresses and scenarios. Then it's another topic that we see a huge difference between banks. No matter whether it's big or small, we see a huge difference in banks in the interest of doing this. So we see some banks that really want to understand that how can I really make my own stresses, make my own scenarios, and they really want to invest their time into learning the tool, understanding the data, analyzing the results. And then we see some banks which are quite the opposite. They do the regulatory, the minimum, like the tick the box exercises. And obviously we are very much in favor of the former, where we provide a tool that clearly can be used for the regulatory stresses, but then there is, as much as you like to use the tool for internal stresses and your internal use cases.
Yeah, okay. Let's see the results. Okay. How do you think about the results? Maybe Erik first. It's almost a nice divide there.
Indeed, and I think we see that it is still developing, of course, especially the intraday stress testing. I think some banks already being able to execute it, but indeed not on a daily basis. I think that still, of course, in development much.
Yeah, so do you also think it can be like a culture thing and the strategy for the banks to get people excited about intraday stress testing or doing just the regulatory reporting? How do you see that?
What do you mean by that?
I mean, like, is it also something that you should work on with your team to actually prioritize this, to see the importance of it? Like, what is the difference between banks that do sort of the bare minimum and the banks that want to dig into it?
I think it's also about execution power and team size. I think that being able to, if you have for the larger banks, which have, of course, bigger teams, maybe more challenging from that unique data source, of course, and getting all the data in place. But if you have that large team focusing really on liquidity, then of course this is easier to get to. But still, of course, you need to cross a couple of hurdles, especially the data part, to come and then indeed being able to have an appetite and then of course also your stress testing place. So I think, in the end, the day-to-day management, making sure that you have at the start of the day an overview of your most important payments that you can prioritize, I would say it's the first step to take. And then the next one is really also this, being able to stress test and maybe then on a daily basis.
Yes. So start with the data.
Yes, indeed. And then in the day-to-day management, I would say.
Yes. All right. So more about customer behavior. We have another thing that is implicating liquidity, and that is trends are showing that the depositors, they are increasingly rate sensitive, and they're quite mobile. And we see, and we also see at Moores, we work a lot with neobanks and challenger banks, that they are gaining market share. And does this mean that traditional banks must rethink a bit how to forecast and manage? And maybe Erik, in your work, what trends are you seeing in depositor behavior? Are you seeing the same kind of trends when you're looking at the market? And how do you think the bank should adjust their liquidity strategies?
Yeah, this will of course make a huge impact on liquidity. Yeah, we see the platform apps there where you can quite easily shift your money around, which especially for maybe a couple of years ago was still dedicated to a couple of tech-savvy younger people. Now that of course is also that group that is using that is really growing. Then we have the instant payments, of course, regulation that also has quite an impact on that. So as a result, we will definitely see a development in more volatile deposit volume. And as a result, that also means that you will need to change your models. You will need to change the way that you are also looking into this, into also forecasting the deposit volumes. So being able to really also measure that in an appropriate way, adjusting your models in that sense to cater for that, I would say is quite an important part. But we will definitely see also more volatility on that end, and we've seen already that banks that sometimes do not completely follow the market will be of course subject to maybe large outflows or on the other hand inflows. And adjusting for that is quite important, and that will also again impact, for example, the core part of your deposit volume being lower because your volume as a total is more volatile, and that in the end will also impact, of course, how much you can invest on the longer horizon. And that again will of course impact margins. So I think that it's quite an important development to make, to be able to really understand also customer behavior in that sense and being able to also respond to that.
Yeah. And a big part here plays instant payments. So let's take a poll on this topic. So have you already taken some measures to mitigate the liquidity risks around instant payments? And we'll let you answer that while Niklas gets a follow-up question, because this sounds great and we know we should do it, right? But what are practical ways that banks can model and simulate alternative customer behaviors, and how can this be sort of operationalized in liquidity planning?
Yeah, thank you. I think it's maybe building a little bit on the previous comments and also what Erik says. So I think it's key that, well, Erik mentioned the core non-core split, that probably is not something that is changed very often, but it might be good to have available like different kind of scenarios where you have already moved on the core non-core split as an example of your modeling. I mean, any modeling, we know that there's a lot of factors affecting the modeling. How correct is the modeling? Well, it's let's see. I haven't mentioned the AI until now. We're all, I think, thinking that AI will help with the modeling as well. See some challenges there, maybe in explaining then the rationale for what the model tells to do with the runoff. Let's say parameters, for example. So I think from our side, what we are proposing is really that you have a tool where you are able to play around with these different factors. So you have different variations of the core, non-core. Not to say that you would be able to change them, or you would of course not change them in short term, but you have at least the readiness to say that, okay, I have different variants, I have different core cohorts of depositors, I have different segmentation options, and so on. So I know multiple outcomes than the ones that I live by, let's say from the regulatory perspective, and so on and so forth. So I think also then like different style of metrics can tell you different stories. So we see with quite a few of our clients that they adopt quite a lot, increasingly this kind of survival horizon metric. I don't know here in Holland if that's at all a regulatory metric, is it? The survival horizon metric?
I think it's used, but if it's regulatory...
No, probably not. Yeah, in some countries they have some of that. We see increasing adoption of that because it typically tends to tell a little bit different stories from the regulatory metrics, what they tell.
Yeah. Let's look at the poll results. Okay. Erik?
Yeah, it's interesting again. I would say, especially, maybe the French model is then used after all by many banks. Indeed, I don't know.
And Niklas, were you surprised?
No, not very surprised.
Okay, we saw some last-minute changes here.
Some changes.
Somebody changed their mind.
It's improving by the second. Yeah,
yes,
so yeah,
very good.
I think it's still.
Yes.
Instant improvement, yeah.
Yes.
I think it's still early days and the volumes are still being quite low on the instant payment, so maybe that's part of the reason as well, what we see in the results.
Yeah, but we see actions being taken to the large extent. So let's see. To wrap up maybe before we take questions, what we've been talking today about is we need to have robust, we need to have transparent, we need to have fast and integrated models to work across business lines. So this is, nothing is new here, so to speak, and volatility will increase, and we all have heard a million times today that we need systems and frameworks that are agile and scalable. So maybe to Erik, if you would be asked, what should I prioritize here? You can't do everything at once, but what should I prioritize today to future-proof my liquidity risk management frameworks? What would your answer be?
Yeah, I think four main things that we have, of course, already touched upon in the past couple of minutes. But first of all, get the data and also the system landscape in shape, such that you can indeed make that shift to near real time, or at least be able to at the start of the day have a proper insight in your liquidity throughout the day and what you can expect. Then also devise a strategy around that with the risk appetite and some strategy. Okay, what are you going to do when certain triggers are hit in that sense? And I think quite an important one that we didn't really touch upon yet is also have a cross-sectional target operator model in place. That you really integrate the treasury function with risk, with finance, being able to jointly work on that and be able to signal important actions as soon as possible to that right department, but have a joint responsibility on that. And then finally, indeed, I think, start if you have the data in place, start also experimenting with AI in that sense, and what can it bring you to study or forecast customer behavior in that sense, to really update those contractual cash flows into something that you can really expect.
Yeah, and I think we're seeing that as well. If we talk about intraday liquidity risk management, what we're seeing is a lot of different departments are nowadays attending the meetings. So it used to be maybe just one department, but now we're seeing the engagement across functions. So that's really interesting to see in practice as well. And of course, our mandatory AI poll is coming now. Please be ready soon. Anyway, so our question is, if you are applying machine learning or AI in analyzing counterparty behavior and hence improving intraday liquidity forecasts? We're going to let you answer that. And meanwhile, to Niklas, from your experience at Morse, we work with banks from many, many different jurisdictions. What are the key design principles that really support a scalable and transparent liquidity risk management?
Yeah, thanks. I think there's a couple of things. So one is, well, data has been mentioned, source data has been mentioned a number of times. So I think it starts there. There's no going around that. That's painful in many cases, especially for those banks that operate in a, let's say, multi-currency, multi-jurisdiction environment. Then getting that source data architecture in place and the availability, accessibility of the data, that is no mean feat. So I think that's where it starts. Then I think then there is, at the end of the day, the shorter the time period we're looking at, or the shorter, let's say, the more we go towards intraday, real time, near time, and things like that. I think then the more important it is to really figure out what are the material flows and what are the material balances that we're looking at, because you simply, if you really demand real time, and I translate that really quite often to near time, I think it is really a tall order to get everything in order and available. So I think it's really focusing on the material risks. Then I think if we look at the whole spectrum of everything from intraday liquidity to let's say liquidity risk overall, so you have the full spectrum. Let's say one end, like your funding and your NSFR calculation that you do maybe on monthly, quarterly basis, at least from a regulatory point of view. That is one end of the time spectrum, and then you have your intraday liquidity, where you really want to be in this near-time, real-time mode. That's quite a spectrum. And if you're a larger institution, then obviously you will need multiple systems for that. So then really it's really trying to have that in mind, like what is the use case for the different things? Because I would argue that even though our mantra would be, as a system provider, to try to get as much as possible into one system to avoid endless reconciliation challenges and all that you typically have when you have overall or your overlapping systems, then it's really important to understand what is the use case and what are the requirements for the different systems that you need. And then maybe last but not least, something which we've seen very different rates of success is having this kind of operating rhythm, as we would call it, like on a daily basis. What can the consumer of the information and the data expect at different time points during the day? If you're talking about the daily operating rhythm, what can you expect to get in your hand or on your screen when you get into the office in the morning? What can you expect during the day? What can you expect end of week reporting, end of month, end of quarter, and so on? So to have that kind of quite clear operating rhythm, because if you sort that one out and then count backwards, then you can really set the requirement both like from technology and data and operation point of view. So I think that's a key one as well.
Okay, thank you. Let's see our last poll. So, okay. Are we surprised again? I'll give you 30 seconds to react from the shock. No, I'm kidding.
No, yeah. So I think at least good to see that that there are indeed institutions exploring opportunities with the use of AI and also getting the customer behavior in that sense modeled or improved. That's I think quite a positive outcome.
But also it's a bit logical, because to have a good AI and machine learning system in place, what do you need? You need the data, right? And you need really, really good data. Otherwise, it's no point in building one. So actually, if we lead from this discussion, then building something like this also requires that golden source of reliable data for it to make sense. So in that sense, it's a very expert audience we have here. What do you say, Niklas?
I'm not sure whether you noticed, but when you started talking about data quality, it started raining quite.
No.
Yes.
Probably for a reason.
No.
Yes. Indeed. We have 2 minutes left. If you have, yes. We are also going to be on the stand if we can't take all the questions here.
Volunteered to host to be able to throw a dive. Just
Throw and dive. Okay.
Jakob Laurid for Handelsbanken. First of all, thank you for very interesting sessions. I mean, one of the things you mentioned was the depositor behavior and the sort of, beyond the contractual view here. So, I mean, when it comes to depositors, I mean, the fundamental things we all do is, we look at, the currency, we look at the country, we look at the product. If we are taking care of all of these three, and we talk now segmentation, what's the next sort of variable or similar you would think is reasonable to segment on? So, you are down to the sub-product level. What is now the most important? Because we have finite amount of data, so we cannot, do everything. What would you think is the sort of most significant variable now to take into consideration?
Yeah, I think it is really about the stickiness of the client. How quickly will it respond to changes in price? So that's basically price elasticity. I would say that is really the next thing to segment on. And if you
I would, if I were a little bit technically, I would say that's a dependent variable. So, I mean, because sure, that's something you want to get, but that's something you get based on a segmentation or something. So, what sort of independent variable would you suggest to segment on there?
Yeah, that's a good question. Indeed, it's also a bit about, of course, analyzing the data and seeing what kind of groups of customers show similar behavior in that sense, and trying to get those drivers out there. I think that is quite an important step to make also still.
Did you mention size, volume?
No, so that they did not mention. So that's one definitely. That's a very clear answer.
Yeah, but also volume, of course, we did already for quite some time. Segment on that. I think it is also about finding those new drivers that really tell you something about that elasticity indeed.
Thank you.
Do we have time for one more? Do we cut it? Yeah.
Yeah, thanks for the session. I was just puzzled by the polls. Is that there's a lot of maybe, no's, thinking. I was thinking, are we hitting a brick wall, or is it the system runs? Who cares? Okay, comment on it.
Can you repeat the last sentence?
Now, in your polls, it was basically in general, it's no. We're not thinking about it. We don't care. So, are we hitting a brick wall as an industry, or is it the system runs? Who cares?
I'm not sure if I would be that drastic, but I think part of it is that there are certain limitations, a lot of system and data limitations. But I think, for example, the last one, the AI, the machine learning question. I mean, I'm not surprised because if you would use, like you have your perfect AI-powered model to do your deposit runoff modeling, how do you explain that to the regulator? What's the transparency on that one? I mean, you can use it for internal scenarios and internal stresses, and you can augment the regulatory ones. But how do you explain it, like to the auditor or the regulator or something like that? So I think at least for the last poll question, I think that the transparency is still needed for that to happen. I think the tools are there to do the actual modeling, but I think the transparency is not there.
Yeah.
Supermarkets are open seven days a week, 24 hours, sort of. Do you think financial markets will be open for 7 days a week with this new regulation popping up? Not an answer for now, probably. Michiel, please.
No. No, people don't like to work in the weekends.
I think probably no one likes to work on the weekends, but everyone in there are quite a few people working in the weekends actually. So probably financial markets will be open. Don't want to scare you out, by the way. Bad ending of the meeting that you have to work 7 days a week.
I mean, the retail side, it already works 7 days a week. I mean, a customer comes on a Sunday and want to make a deposit or want to use a credit card. I mean, we
Exactly. Yeah. My father is a chicken farmer. He still is. He's working 7 days a week, I can tell you. So probably why not in financial markets? Give it a thought. Probably answers next year. Many thanks for your sharing your expertise on liquidity risk, and thanks for being here all.
Thank you.
And if you have any questions later on, then feel free to reach out to both.
We are by the
Mars
bar,
and,
so you.
they don't only like liquidity but also liquid.
Yes.
So they're probably at the bar for the rest of the day.
Yeah.
Thanks for being here.